Welcome to the Money Major channel, where we help you establish financial freedom and take your life to the next level. You need to hear this if you're a beginner investor. Investing can seem super intimidating, especially if you're just starting out. But the truth is, investing is one of the most powerful ways to build wealth over time, and it's not as difficult as you might think. Whether you're dreaming of early retirement, buying your dream home, or just having more financial freedom, investing can help you get there. In this video, we're breaking down everything you need to know to start investing today, even if you're starting from scratch. We'll cover everything from setting your financial goals to choosing the right investments, and I'll give you some of my top tips for making smart investment decisions. So grab a notebook, get ready to take some notes, and let's get started on your journey to financial growth. Before you even think about buying stocks, bonds, or anything else, you need to define your why. Why are you choosing to invest? What are you hoping to achieve with your money? Think about your financial dreams. Having clear, specific goals will not only give you motivation, but will also help you make smarter investment decisions down the road. Write your goals down and be as specific as possible. The more specific you are, the more real and achievable your goals will feel. The investment world can feel like a jungle, with all different beasts. Stocks, bonds, mutual funds, real estate, the list goes on. Don't worry, we're going to break down these investment animals one by one. First up, stocks. When you buy a stock, you're essentially buying a tiny piece of ownership in a company. If that company does well, its stock price goes up, and you make money. Of course, if the company doesn't do well, the stock price can go down, and you could lose money. Stocks are considered higher risk than some other investments, but they also have the potential for higher returns over the long term. Next, we've got bonds. Think of bonds like IOUs. When you buy a bond, you're loaning money to a company or government. In return, they promise to pay you back the original amount plus interest. Bonds are generally considered less risky than stocks, but they also typically offer lower returns. Now let's talk about mutual funds and ETFs, or exchange-traded funds. These are like investment baskets. They hold a bunch of different stocks and/or bonds, allowing you to diversify your investments with just one purchase. Investing always involves some degree of risk. The name of the game is finding the right balance between risk and potential reward, and that depends on your individual risk tolerance. Think of it like this. How much money are you comfortable potentially losing in the short term in exchange for the possibility of higher returns in the long term? On the other hand, if you're younger and have a longer time horizon, you might be more comfortable with a higher risk tolerance. It's all about finding what feels right for you and your financial goals. Here's a secret. You don't need a ton of money to start investing. In fact, you can get started with as little as $5 or $10 on some platforms. The key is to start small and be consistent. Remember, investing is a marathon, not a sprint. One of the best ways to do this is through dollar cost averaging. Here's how it works. You invest a fixed amount of money at regular intervals, say $100 every week or $500 every month, regardless of what the market is doing. This approach can take the emotion out of investing and help you stay disciplined, even when the market gets bumpy. The most important thing is to just get started and keep investing consistently. Now that you're ready to start investing, you need to choose a platform or brokerage account where you'll actually buy and sell your investments. Think of it like choosing your financial wingman. You want someone you can trust, who has your back, and who won't charge you an arm and a leg in fees. There are tons of options out there, from traditional brokerage firms like Fidelity and Vanguard to more modern app-based platforms like Robinhood and M1 Finance. So how do you choose the right one for you? Here are a few key factors to consider. First, fees. Every platform charges fees for things like trading, account maintenance, or fund management. Make sure you understand the fee structure of any platform you're considering and compare to find the most cost-effective option. Second, ease of use. Some platforms are more user-friendly than others. If you're new to investing, you might prefer an app-based platform that's simple and intuitive to use. And lastly, the types of investments offered. You've probably heard the saying, "Don't put all your eggs in one basket." Well, that applies to investing too. Diversification is one of the most important concepts in investing, and it's all about spreading your money across different types of investments to reduce risk. Think about it like this. If you invest all your money in a single stock and that company goes bankrupt, you could lose everything. But if you spread your money across different stocks, bonds, and other asset classes, the impact of one bad investment is minimized. One way is to invest in a mix of different asset classes like stocks, bonds, real estate, and commodities. Another way is to diversify within each asset class. The goal of diversification is to create a portfolio that can weather market storms and generate consistent returns over the long term. Investing is a long game, my friends. It's not about getting rich quick or trying to time the market perfectly. Those who try to time the market often end up buying high and selling low, which is the opposite of what you want to do. The most successful investors are those who have a long-term perspective and are willing to ride out the market's ups and downs. Think of it like planting a tree. You wouldn't expect to see fruit overnight, right? It takes time, patience, and consistent nurturing for a tree to grow and bear fruit. This means resisting the urge to check your investments every day or panic sell when the market dips. So stay focused on your long-term goals, tune out the noise, and let the power of compound interest work its magic. The world of investing is constantly changing and evolving. That's why it's so important to be a lifelong learner and continuously educate yourself about personal finance and investing. The good news is, there are more resources available than ever before to help you become a savvy investor. You don't need a fancy degree or attend expensive seminars. There's a wealth of information available online, often for free. Start by learning some basic financial concepts like compound interest, market trends, and how to read stock performance charts. There are tons of great websites, blogs, and YouTube channels dedicated to making investing accessible to everyone. Remember, knowledge is power. The more you learn about investing, the more confident and informed your decisions will be. Investing can be a great way to grow your wealth, but it's important to be aware of the fees and taxes that can eat into your returns. Let's start with fees. Investment accounts often come with various fees, including trading fees, account maintenance fees, and fund management fees. These fees might seem small, but they can add up over time, so it's essential to choose low-cost investment options whenever possible. Now let's talk about taxes. The way your investments are taxed depends on the type of account you have and the type of investment. Understanding the tax implications of your investments can help you make more informed decisions and potentially save money in the long run. For beginners, I often recommend starting with index funds or ETFs. These are like the all-star team of the investment world. They offer a simple, low-cost way to get started with investing and can help you build a diversified portfolio without needing to pick individual stocks. An index fund is a type of mutual fund that tracks a specific market index, like the S&P 500. ETFs are similar to index funds in that they also track a specific index or basket of assets. Both index funds and ETFs offer instant diversification and are known for their low fees, making them an excellent choice for beginners. Remember, investing is a marathon, not a sprint. The most successful investors are those who stay consistent with their contributions and let their investments grow over time. It's easy to get caught up in the day-to-day fluctuations of the market, but try to avoid checking your investments too often. Instead of trying to time the market or chase the latest hot stock tip, focus on what you can control, making regular contributions to your investment accounts and staying disciplined with your investment strategy. Remember, time is your greatest asset when it comes to investing. The sooner you start, the more time your money has to grow. Start small, stay consistent, be patient, and watch your wealth grow over time. Thanks for watching. Remember, investing doesn't have to be scary or complicated. By taking the time to learn the basics, setting clear goals, and developing a solid investment strategy, you can set yourself up for financial success. Investing is a journey, so stay patient and focused on your long-term goals. Don't get discouraged by short-term market fluctuations or feel like you need to have all the answers right away. So take what you've learned today, start small, stay consistent, and watch your wealth grow over time. You are now ready to take the next step to financial freedom. The Money Major channel is packed with next-level information to help you achieve your financial dreams. If you found this video helpful, hit the like button and subscribe to our channel. Join our community and let's embark on this journey to financial freedom together. See you in the next video, boss.